Hello, everyone. Welcome to a new lesson from Know How. This lesson is about how investors and financial markets view businesses. Today, we're going to explore not just how they see them as organizations, but as drivers of investment returns. From an investor's perspective, a business is fundamentally a return generating engine. The investors provide capital upfront and expect that the company will use those funds wisely to generate future cash flows. That is why a company's goals and business plans matter so much to investors because they're focused on future cash flows. It's by reviewing the goals and plans that investors get to understand what the business will do with their money. And not only are they interested in what they will do with the money, and if the business will generate a return, they also want to know if the returns that are going to be generated will exceed what the investors can get elsewhere in an investment of similar size, timing, and risk. So to put it differently, investors don't buy just into current performance. Of course, current performance matters, but what they're buying into is the company's cash flow story, the expectations that, that the company has about generating returns commensurate with the risk and timing of the investment. Let's look at how this relationship between investors and businesses work in practice. First, we'll talk about the flow of funds between investors and the firms. So if you look at the screen or the visual on your screen, you see on the right-hand side investors who provide capital to firms. The firms in turn deploy this capital into operations for expansion, for R&D, or even acquisitions. And in doing so, the firm is investing in tangible and intangible assets, some of which may be long-term and some of which may be short-term. Deploying these assets, the firm generates cash flows. These cash flows, though, split into three parts. One is first, the cash flows have to be used to pay all the stakeholders who contribute to the generation of the cash flows. So there's payments to creditors, there's payments to employers, there's payments to landlords, payments to electricity providers, to banks, and so on, and then even to governments for that matter, right? And the form of taxes. So what's left over is either reinvested back in the company or shared with investors. Now, if the company is a young startup with strong need for cash and with lots of prospects, then most of the cash flow is going to flow back into the company. If, however, the company is mature, like say a well-established consumer products company, generating a ton of cash, but really not in a mode of growth, then they are able to return most of the cash that is generated, if not all, to investors. And often you see this in the form of large companies paying out dividends. So what this graphic suggests is that there is a feedback loop. Investors provide capital, firms invest the capital, the cash flow generated from the assets acquired using the capital is then shared with investors. Now, this feedback loop is particularly important because most companies are not accessing capital as a once and done exercise. Especially if they're growing, they continue to need to access the investor base. So this creates a cycle because when investors provide capital and the firm does well with the capital, the investors have confidence in the business and are willing to provide more capital in the future. If the investments do poorly, that reduces investor confidence, and that in turn impacts the ability of the firm to raise capital in the future. So, at a high level, this is how the flow of funds from investors to the firm and back to investors work. Now that we understand the flow, we'll turn our focus to what investors uh, expect the firm to do when they say that the firm should invest capital wisely. But before we can do that, we need to take a short detour and talk about the different types of capital that investors provide. As you can see on the right-hand side, we have listed under the in the investor column two types of capital: debt and equity. So broadly speaking, let me switch slides here. Capital comes in two main flavors: debt and equity. There are, of course, other forms of capital too. For instance, convertible debt. Convertible debt is a type of debt in which it has the form of debt for the most part, but also has a feature which allows it to be converted to equity. So you can think of it as a hybrid security with some features of debt and some features equity. But in its core, convertible debt and other forms of capital are variants on a theme of debt and equity. So debt and equity being the primary forms of capital, and various hybrids or variations on a theme, other forms of capital being hybrid or variations on a theme here. We'll focus first on equity, just so that we understand it well. Now, equity represents ownership in the firm. This ownership capital, just so you know, is often referred to using multiple terms, and it's good for you to be familiar with those terms. Sometimes it's called equity capital. And other times it's called stock of equity capital. Yet others refer to as the shares of stock, and sometimes simply as equity or stock or shares, and so on. They all mean the same thing, but I just want you to be familiar with the various ways in which equity or ownership capital is labeled. But it's, no matter what it's called, at the end, all it represents is a direct ownership stake in a business. Now, as is the nature of ownership, equity holders get paid only after everyone else. And by everyone else, I mean employees, vendors, lenders, and even the government is paid. For that reason, equity investors are said to have a residual claim on the firm. And given that the equity investors get only the residue, or what is left over, equity investments are considered risky. On the positive side, though, when the earnings of the firm exceeds what it owes all the other stakeholders, what's left over, the equity holders get to keep all of that. Greater the margin by which the company exceeds its commitments to other stakeholders, greater the reward to equity holders. So equity capital is both risky, but also potentially more rewarding. Thus, for equity capital, what we see is that the business makes no commitment to investors to pay out a fixed amount. That is, there is no fixed obligation. And I call that out because that's very different from debt. Debt is a fixed obligation. The business pre-commits both to the specific amounts that they will provide the investors, and also the schedule of those payments. And what's more interesting is that those payments have to be made regardless of how well the business does. If the business does spectacularly well, the debt holders still get only the fixed payments. They do not get anything beyond the fixed payments. If the business does poorly, the debt holders still have a claim on the pre-committed amounts. So the commitment is to make the debt payments regardless of how the business does. So it's very clear that the payments are very asymmetric. Debt holders get paid before equity holders, but don't get to participate in the upside. In contrast, equity holders are last in line, but they get to keep all of the upside. This concept comes sharply into focus, even more sharply into focus, when you consider the extreme case of bankruptcy. During bankruptcy, employees, suppliers, and creditors have to be paid first. And stockholders the only portion, receive the portion of the firm, of the liquidated firm, only after all of these obligations are fulfilled, and that too only if anything remains. So this risk reward structure explains why equity investments typically demand higher returns than debt investment. But at its core, all that is in stockholders demanding compensation for assuming the greater financial uncertainty that comes with equity ownership. So now that we have made the distinction between debt and equity capital, the next question is, why does that matter? The distinction is crucial because it shapes how investors evaluate risk and return. Further, this distinction feeds into the discussion of what investors think a firm's financial goal should be, which is the topic that we're going to explore after, or next, I should say. So, on the topic of what a firm's goal should be, when I ask this question to my undergraduate business class, I get a range of answers. Some say the goal of the firm is to maximize revenue. Others say it is to maximize profits. HR majors have said it is minimizing employee turnover. And yet others have said it is to avoid bankruptcy. So you can see it's a whole range of possible goals of the firm. None of them are wrong per se, but what's interesting about these goals is that many of them will conflict with each other. For example, minimizing employee turnover might be great in a normal circumstance, but if the company goes through a downturn and starting to make losses and it has to cut costs to survive, the goal of minimizing employee turnover might uh, conflict with the goal of maximizing profits or even plain survival. Another example is a firm that tries to maximize its current profits by cutting down investment or R&D. So in the near term, it generates more cash flows because there is lower investment and R&D expenditures. But in the long run, it impacts the ability of the firm to grow. So if these are all good goals, but they conflict with each other, how do we choose the right goal for the firm? It's clear that we need a unifying goal, one that captures the essence of all these objectives. But the question is, what is that goal? So let's see what financial theory says about that. I'm going to start by spilling the beans. Financial theory tells us that the fundamental goal of a business should be to create value for its stockholders. The moment you hear that, you're going to ask the question, why stockholders? Isn't this too narrow a goal? To see why, remember that the stockholders are residual claimants of the firm. That is, from the business they own, they receive payoffs only from what is left over after employees, suppliers, creditors, and even governments or for that matter, everyone who's owed by the business are paid. If there isn't enough to cover all these commitments, the owners, as residual claimants, receive nothing because they're last in line. Since this is the case, it also means though that if they do well, by definition, everyone else, all the stakeholders, employees, suppliers, creditors, all would have already done well. Because if they had the fact that equity holders have residual profits available to them implies that all other stakeholders' claims have been paid. It is this logic that is the basis of the stockholder value creation goal. Now, some of you may be going, that sounds logical, but does this mean that only stockholders matter? Let's talk that through. The answer to that question is not at all. Maximizing stockholder value does not mean ignoring other stakeholders. The goal of stockholder value maximization does not imply that business owners should take action that increases equity value at the expense of other stakeholders or pursue legal or unethical actions that might maximize their value. For a company to succeed in the long run, many things have to happen. For instance, employees must be treated well to stay motivated. Companies have to compensate employees properly and provide safe working conditions to prevent attrition of employees and to maintain motivation. Because if you don't and you treat employees poorly, in the long run, it will ultimately harm shareholder value. Similarly, customers must also receive value. Organizations that fail to provide valuable products or services will see customers go elsewhere, ultimately undermining the success of the firm. And for similar reasons, communities must be respected too. Being a responsible community member helps protect the company's brand reputation. Firms that neglect community relationship creates risk of a adverse impact on long-term shareholder value. For instance, if you have a company that tries to maximize shareholder value by polluting the environment in which it operates, that may impact how customers see the company, how investors see the company, and it may even impact when the company wants to expand its operation and needs permission from the local community or other communities to set up a new factory. So you can see that in order to maximize shareholder value in the long run, the, the company cannot afford just to focus on stockholders. They have to address the needs of all of the other stakeholders in order to maximize shareholder value in the long run. So long story short, long-term stockholder value depends on how well a company manages its relationship with all of its stakeholders. Okay, so we now have a goal that financial theory tells us that a firm should do to keep investors happy, and that is to maximize shareholder value. Sounds great on paper, but unfortunately, this goal gets complicated in real life very quickly when companies grow. When a business exceeds a certain size, aligning everyone's interest becomes complex. Let's see why. I'll use an example of a family-owned restaurant. When it is a single restaurant and relatively small in size, all of the family members are involved and they run the family business well because the owners are the one managing the business. And so everyone's incentives align naturally with the business's success. They benefit most when the business thrives and suffer most when it struggles. However, this alignment between the owners and the managers become challenging to maintain in large companies due to what's called the separation of ownership and control. As businesses grow, ownership and control often separate. Shareholders own the company, but managers or executives run it. When the people who own the company differ from those who manage the company, interests can diverge. Managers acting as agents of the shareholders may make decisions benefiting themselves rather than company owners. This creates what's called an agency problem. Let's think of a couple of examples of this. So, if you have a manager who chooses to invest in risky projects that boost their department's profile, but do not necessarily create shareholder value, then you have a case of an agency problem. The manager is acting in their self interest, not in the interest of the company. Or another executive might resist cost cutting measures that could improve profitability, but rather because they see that when the size of their team reduces, their influence in the organization declines. That's another example. And you see all kinds of examples every day in most organizations. I'm sure you are familiar with some versions of it too in your day to day lives. And just to be clear, this is not just a theoretical concept. We see this in real life, sometimes in big ways. I'll give you a couple of examples of very prominent cases of agency problems. Some of you might remember the Enron scandal from the early 2000s. At Enron, executives engaged in accounting fraud to hide debt. And through hiding debt, they inflated the profits of the company, which in turn boosted their bonuses, even though it ended up costing shareholders large sums of money in stockholder value. Another more recent case you might recall is that of Wells Fargo. In the mid 2000s, there was a scandal at Wells Fargo about opening fake accounts. Employees opened millions of unauthorized accounts to meet sales targets because their compensation was tied to the number of accounts that was open. And so they prioritized their personal bonuses over shareholder value and customer interest. Okay. So the agency problem happens both in day-to-day circumstances, but at many times, in very impactful and consequential ways. So now that we know that the agency problem is a real thing, let's look at solutions for how this misalignment can be fixed. And as investors, we can have reasonable confidence that the shareholder value maximization goal is indeed realizable at the firm. There are three ways in which companies try to align interests. The first is through managerial compensation. Now, it is true that management typically has a natural incentive to increase shareholder value because managers who have a track record of doing so tend to be respected in the market and command higher market value and salaries. But to go beyond reputational considerations and for direct influence, it helps when the compensation is directly tied to financial performance and share value. So when the company does well, the executives get greater levels of compensation. Okay? So that's the approach taken in the form of managerial compensation to align interest. The second way that companies adopt is to align interest is through corporate governance. Corporate governance refers to the systems in place to ensure alignment of interest. At a pretty high level, corporate governance is implemented through the accountability created by board oversight. What shareholders do is to elect independent directors. So the independent directors are elected by and represent the shareholders who elect them. And they are given the critical role of oversight of the company. The board of directors oversee the executives of the company, and they have the ability to influence because they have the ability to hire and fire executives. Additionally, by regular performance reviews, most companies have what's called a quarterly business review, where the board reviews the performance of the company over the prior quarter and provides strategic guidance to make sure that the company is operating in the shareholders' best interest. The third approach that companies take to manage or align incentives is through what's called control mechanisms. At the extreme case of this is, consider a company where the shareholders have elected a board of directors, but the directors don't end up acting independently enough. They don't end up acting in the interest of shareholders. If that is the case, shareholders can then resort to their ultimate form of control. That is to replace the directors and then in turn, through them, replace existing management. So this list is not exhaustive, but broadly speaking, these are some of the ways in which companies look to align the interest of the company, interest of the shareholders, I'll take that back. So these are some of the mechanisms that companies use to ensure, or the stockholders use to ensure that the companies act in their best interest, and thereby reducing agency problems. When properly structured, they create a system where managers' personal success becomes directly tied to creating long-term shareholder value. But the key is that's only true when the systems work well. The reality, again, though, is that the effectiveness of these mechanisms varies significantly across companies and markets. And that is why corporate governance remains an evolving effort and a crucial aspect of business management. Okay. So that brings us to the end of this lesson and brings us full circle back to the idea that investors view businesses as return generating engines. Their confidence in the engine grows when there's alignment between managers and the shareholders, and the firm is run to maximize shareholder value. Again, thanks for your time. Hopefully this lesson has introduced you to the investor's perspective of the business and how they seek to ensure that the business is run in a way that's aligned with their interest. So see you at the next lesson. As always, if you have any questions, feel free to reach out. Happy to discuss any specific topics that may have been unclear to you in this lesson. Thank you.